Right, nice to be with you guys this afternoon. We are going to be looking at relationships between markets today. So we're going to have a bit of a combination of a theory session with a bit of practical, and we'll sort of move over to the PowerPoint presentation in just a moment. And one of the key things that we're going to be looking at is the dollar index. Now let's just take a very, very brief look at the chart of the dollar index. Just get the right one here. There we go, coming on up. And there we have a chart which in a moment, yep, it's popped up there. I can see it on my spare monitor. Where we have got a chart of a downtrend. Now, if ever that was a downtrend, well, it's looking really, really quite interesting that maybe price is no longer in a downtrend. Is there now some evidence that just maybe this is turning? Well, that's a rhetorical question at the moment, and I'll probably put some of you guys on the spot as we go through. But what has actually happened is that we've got the dollar bouncing up, and we've seen quite a major bounce. And one of the real key things here, as far as I'm concerned, is what has actually happened to price moving up through this critical level. Now, I'm just going to pop a line on, and we've got a line which is at that critical level. And the critical level for me, when I'm looking at trends, and we'll look at trends and what is going to sort of decide the trader on what actually is a trend and what isn't a trend, is the fact that price has actually popped up through that previous, what was a lower high. It was a lower high because price subsequently actually went lower a few weeks ago. But price has now actually gone on up. So that is the first part of suggesting that just maybe we've got a trend changing here. Now, markets do not work in isolation. They do not work in isolation. In fact, most traders, I guess, when they sort of start out, they do a bit of analysis. They sort of look at a particular instrument and think, yeah, I'm really going to get stuck in. I'm going to trade this particular thing, whatever it is. Might be the dollar index. Might just be one of the stock indexes. In fact, the stock indexes is where most people start, apparently. Now, if you just trade a stock index, or indeed you trade the dollar index, or if you go for individual stocks or individual currencies, then so often the movement in that particular instrument, whatever it happens to be, is being kicked off by something or other else somewhere. Now, these interrelationships between these markets are very, very closely wrapped up with interest rates, what the stock market is doing, what's happening with gold, what's happening with commodities, and so on. So there we are. That's going to be the starting point, guys. So let's now just move over then and get started on a little bit of theory. Right, now bear with me a second, just got to switch over to the PowerPoint, and we may well find this presentation just goes off for half a mo. Right guys, now I've had to click quite a few little buttons there, but with any luck you can see a little presentation there, and right, intermarket analysis and trading opportunities is what we're looking at today. And right, okay, so those opening comments talking about the dollar index and what sort of goes on in terms of relationships with other markets is exactly what we're going to be exploring today. So let's just sort of work through this. Don't hesitate to maybe pose one or two questions as we go through. A fair number in the room, so it may possibly be something that I don't pick up at every single question, but don't hesitate as we go through. So let's just take a little look at the various markets that there are. Now, just down on the bottom left of the screen, you should be seeing a little graphic, and that's representing the size of the equity markets in plural. And what does it trade? Well, arguably around about 100 billion a day. Clearly, it has its moments when it goes above, and there are going to be other times when it can settle right back again into quite a small number. But it's a big market without a doubt at 100 billion a day. Just think of all that cash sloshing around. Now, there is another market which absolutely, totally dwarfs that equity market. And this arguably is the most important market in the world with a sort of a capital THE. And it's the bond market. Now, people say, well, bond market, what's a bond market? I don't play bonds. What are these things? Well, quite simply, the bond market is the global interest rate market. And it's a massive market, massive market. Now, if you just think of the amount of money that there is sloshing around the world, and that money wants to always earn as much as it possibly can, okay? And if it can be moved to somewhere where there's an infinitesimally better slight increase in the sort of rate of interest, in what you can actually earn on your money, then that is going to attract the cash in. And of course, the bond market is largely corporate debt, it's government debt, it's local authority debt, and so on. The entire world runs on debt. And I guess that you and I have probably got a few credit cards that every now and again we hit them hard and give them a bit of a thrashing. Right, now, I'm not quite sure where else you're going to get the dollar index, but I can suggest a free set of charts. If you go to netdania.com, okay, if you go to netdania.com, then you will find that they have got an excellent thing called ChartStation. There you go, that's the link for it. And yeah, well, there we go. I mean, Alex, you sort of mentioned a couple. You can get it all over the internet, but I really do suggest that NetDania, absolutely brilliant free charts. They're live. Every now and again they go a little bit slow if if it's during a news announcement or there's a whole stack of market activity. But it's not just forex. You'll have sort of indices and so on. So now let's just see what we've got next to come up, and there we are. We've got an even bigger market. An even bigger market. No prizes for guessing what this one is. It is the Forex market. It's the Forex market. Now, I haven't actually noted that down, but just look at the numbers. In excess of 3.5 trillion. I mean, there were times when it was, full marks, guys, full marks. There were times when the market has exceeded 4 trillion in a day, we are told, and this is largely spot. Futures, I can't give you the split, but if we went back, say, 10 years, then there wasn't a great deal going on in the futures market, but also the spot market wasn't as accessible to the retail trader as it now is. Now, in sort of, I suppose, the last sort of 5 years, and it's really accelerated since we've had the big crash in 2008, and it's now become every man and his dog can trade forex through the thousands of retail brokers there are out there. But the futures market is important. The dollar index, for instance, is a futures contract in itself, so one can actually just buy and sell that particular contract, and there's a lot of activity that does go on in the futures market. People say, well, could you arb between the two? Could you sort of hedge between the two? Well, not really, because any arbing opportunity is just sort of sucked out of the market in a blink of an eye. Right, of course. Yeah, I mean the whole thing just runs on leverage, and the amount of leverage that there is in the market is absolutely phenomenal. But this does represent what the underlying is, what the underlying contract. So when sort of you or I go and buy a standard lots of $100,000, and we're just putting up, I don't know, the standard sort of couple of $1,000s in margin, then what this is relating to is the full 100,000. So there we go. There we have it. Right. So there we are. There's the three markets. Now all of those are totally interlinked. Totally. So you get a movement in one, it is going to affect another. It's a rather like the fractal idea, you know, that suggestion that came out quite a few years ago, where you get a butterfly flaps its wings on the other side of China, and a storm descends on New York. Well, one hopes that doesn't happen quite like that, but there we go. Right, so this is the basic tenet that no market is an island. All markets will have some degree of linkage and consequently some degree of correlation with others. Now there are some markets which have very little relationship between each other, but the main markets that we're considering, certainly those three main markets we just looked at, then they certainly do. So stock markets then, interest rate markets, and the one that I've not mentioned are commodities. Now commodities are probably the most pure of all the markets that there are, and also the very, very, very oldest markets. Because you can just imagine sort of going back a couple of hundred years, or go back a couple of thousand years, people needed commodities. Now, staple foodstuffs that people would consume. Now, way back, staple foodstuffs would have been an awful lot different to the foodstuffs that we have today. But people had to exchange and barter with them. And consequently, those who had lots of commodities, basic foodstuffs, piles of wood for fires and all that sort of thing, then those people had a bargaining counter. They had an asset. They had an asset, and they could trade with that asset, and hopefully trade up and make more out of it. Not all of them, Sissy Barner. Do have a good look. In fact, they've recently brought on a whole number of additional bits and pieces, so you just might better pick them up there. Right, so there we are. By a little bit of knowledge then that's happening in one market, you just may be able to trade a related one and profit from it. So, now then, got a question for you guys. What drives currency markets higher or lower? Right, that's the first question for you. Is it just one thing? Right? Oh, I like it. Excellent. Brilliant. Oh, look at this. Absolutely. You've got them all. You've absolutely got them all. So, interest rates is right up there. I mean, that's one of the primary ones. That's one of the main drivers of currency markets. If those interest rates are going up or down, there are economic fundamentals, of which there are a good many. Capital flows which come out of some of those economic fundamentals. It may well be that we've got an oil company who need to pay for a brand new refinery in another country. Well, what are they going to use to? It might be a UK company needs to get dollars, and the payment is going to be made in dollars. So you get a big transaction of several hundreds of millions going through, big capital flows. We may well get one stock market starts to tank and money is coming out of that country because there's a lot of risk involved. So out it comes. So we get capital flows. And of course, I really do like that one. Greed, fear, human emotion, speculation, which is all wrapped up around in that sentiment word. So we've got these drivers. We've got these main drivers. And of course, let's then just look at interest rates. Now, certainly in the short term, as we can see with the various announcements that come out, the market is well and truly, it's got a fixation on interest rates. And it wants to know if those interest rates are rising or indeed falling, but into the future, that the whole markets are a discounting mechanism. They take whatever information that there is on the table right now, and they will then make forward predictions based on that body of information that there is. So it's always looking into the future. And although this is mentioning in the short term, looking into the future, well, the markets are always looking 3, 6, 9 months ahead, minimum. And then, of course, there are those who dig out the crystal ball, and they are looking much, much further ahead. Certainly those people who are trying to take long-term planning decisions for, well, let's just go back to that oil refinery analogy. Well, hopefully an oil refinery is going to last more than 3, 6, or 9 months. It's going to be around for 20, 30 years. So they want to get their forward planning absolutely right. So, any news announcement which can relate to rates, and pretty well all of the announcements can all be linked back to what is going to happen to interest rates in the future. So this is the real big one that does need to be well and truly taken on board. And of course, what are these statements? Well, we get central bankers coming up with various comments. We got Paul Volcker in the room today, and Paul, you used to be very, very good at coming up with little statements back in your sound dollar days. And we've got trade balance figures. The right, yeah, sorry about that, Paul. And we've got all of this raft of figures. We've got these statements that come out from some various Fed chairman. We've got CPI numbers, PPI numbers, of which we've had a few this week already. So we've got inflation numbers, we've got GDP, we've got gross national product, and of course we've got payrolls as in the first Friday of a month, when it's probably a good idea just to sit tight and stand aside and let the markets get on with it. And then, of course, we've got retail sales, housing starts, tax cuts, increases, and so on. Every single one of those will have an interpretation that will result in an analyst saying, right, that announcement is either going to be bullish or bearish for interest rates, meaning interest rates could go up because of it, could go down because of it, or indeed might be quite neutral. It's immediately translated into what is it likely to do to interest rates. Now, this fixation is a major fixation, and you can sort of look on it as being a neurosis. It's a bit like the manic depressive neurotic, which I suppose we've all got a little bit of that in us from time to time. And the market is neurotic. It's neurotic about interest rates. Hi, Paolo. Glad you could make it. Right. Now, there is certainly an awful lot influencing Forex. So let's just look then at the interest rates and bond yields then. Discounted ahead is the most important. And there is a little trade called the carry trade that can result in long-term trends which absolutely go on for donkey's years at times. But equally, it can be also a relatively short-term phenomenon. Now, we're going to look at the carry trade in a bit. We just sort of look at some of the details on it. But one of the key points about the carry trade is that it's an interest rate play, and it uses, for a good many people, not just the currencies, but it involves buying bonds, high-yielding bonds, and so on. But of course, using the currency markets to put those trades on in the first place. So those carry trades, if they're going to last for years, then when they unwind and you get years worth of activity unwound in a short space of time, as we did see in 07-08, then that can have a dramatic effect. So it's always a good idea for the Forex trader to have in mind and to be aware of what was actually going on with the carry trade and what the exposure is on the carry trade. Anyway, more on that in a while. So let's just consider some of the other things then. Stock markets, up or down? Have we got things rising or falling? Does the activity look really good or not? Do some countries produce unique commodities that the rest of us actually want? Well, there are some of those countries who do actually produce some commodities. There are, of course, a number of countries which are quite the opposite and actually haven't got any of those staple commodities that all us ordinary mortals need day to day. And consequently, then those countries are going to be at the mercy of whatever those commodities prices actually are. Yeah, you're quite right, Jack. Absolutely, yeah. Now, because the rate differences are so small, then the impact is to some extent reduced, but it's all relative. Now, going way back to, I was in a conversation with some guys earlier. We're just sort of mentioning briefly about the, of course, euro is very much on everybody's mind at the moment. And it went back to when Norman Lamont, the UK Chancellor, decided to not attempt anymore to keep the UK in the ERM, exchange rate mechanism, and consequently the euro. And of course, back in those days, interest rates in the UK were up around 16, 17%, absolutely unprecedented numbers. But worldwide interest rates were relatively high also, and it was just something that everyone learned to live with. I mean, it caused quite a few problems, certainly for the business I was in at the time, but it's all relative. The relative difference is much the same in percentage terms as maybe it was sort of way back then. So it's the relative relationship which is the important thing. Right, now let's look at one or two of these other bits and pieces. Now, fundamental political risks. Are there fundamental political risks? Now, clearly in some parts of the world there are. And in other parts of the world where, hopefully we all live, then those political risks are arguably an awful lot less. And of course, the other big one is coming back to what you guys were saying earlier on, which is has sentiment taken over. And of course, on everybody's lips right now, we're just sort of listening to news reports on the wires. Will the euro survive? Is the big question. It is the big question. And I wouldn't mind just taking a straw poll of you guys. Yes or no? This information will not be passed on anywhere else. It's interesting, that. Interesting. Yeah, it looks like there could well be some modified version. And, is that going to be... Yeah, exactly, Philip. Yeah, I was just about... Absolutely right. Yep. Could there be a two-tier euro? And it looks very much as if that's really what is required, certainly when you consider what is going on with Ireland and Greece. Yeah. Good point. Yeah. Yeah, I think the end game, when all of this gets itself sorted out, there are going to be a lot of banks that never ever get their money back. Yeah, absolutely, absolutely. Yeah, yeah. I mean, one of the things just to sort of keep in mind is what is going on with Germany, and is the euro more of a Deutschmark, okay, than it is an Italian lira? Well, yeah, it would look that way. And just if Ireland, etc., decided that they could somehow just step sideways and go back to their old currency or create a new one which could be devalued, then what effect would that have on the euro stroke Deutschmark? Would it go up? Would it go down? There we go. Right, Boyke, quite simply, the UK could not fit into all of the requirements, all of the fiscal requirements, with sort of what the various ratios were, taxation and all the rest of it, to actually do what was necessary to keep the pound sufficiently strong. It was just unable to do it. Unable to do it. Rob, I think you could well be right. I think you could be right. Now, George Soros just happened to be one of a bunch of people who were selling it short. But anyway, there we go. Right, so yeah, you're quite right. We really should have the haven't we got a little maple leaf tucked away in there somewhere. Right, now let's just go and look at some of these main pairs then. First of all, we've got the euro. Chart on the top right, that's the euro. Happens to be the euro USD, that particular chart. But of course, it's the euro itself is traded against a good many other currencies, and it's been described as the world's second reserve currency. Now, what is a reserve currency? Well, quite simply, it's a currency that people keep in reserve, meaning that central banks will have a stock of them. You know, they've got reserves, and some of those reserves are going to be in euros. Now, a lot of those reserves are going to be in the US dollar, but of course, as the US dollar has just been collapsing over a good many years, say collapsing, probably a slightly strong word, but as it's been moving south over a long period of time, and the euro has been gaining on the back of it, then central banks are just keeping them a good many euros tucked away. And indeed, there has been quite a good deal of world trade going on, particularly oil swaps going on with sort of Russia and so on, and they tend to keep their eggs in a couple of different baskets. Right. Okay. So structural problems north and south, and that could also cause a little bit of a problem as you guys have just discussed. Right. Now, next door to Europe, I mean, Europe, in terms of a trading bloc, is an enormous trading bloc. The Swiss have got a much, much smaller country, and they are independent of the euro, so they've kept their own currency. Now, one of the really interesting things is that the Swiss have got gold reserves, and they partially back their currency with gold. Consequently, a lot of people, a lot of investors like the idea of that, and whilst we've had these times of uncertainty, the Swiss have suffered very, very badly, and they've suffered because it's a safe haven currency. Okay, so if you're a little bit concerned about the US dollar and you've got a load of money in US dollars, then let's go and bung it into something which is a much, much safer currency, and that much safer currency would appear to be something like the Swiss franc. The only problem is that drives their currency up and drives their competitiveness down. Okay, it drives their competitiveness down. And of course, these two currencies are inversely correlated. Now that correlation fluctuates somewhat. It's said to be around about 80% in the longer term, or 0.8 positive. And we have seen times when the Swiss have attempted to reduce the value of their currency against the euro, which is their major trading partner. They've attempted to reduce it by intervening and selling, effectively selling, and selling their own currency to boost the euro. But it didn't work. It didn't work. Cost them an awful lot of money, and eventually they gave up. But the question now is the market actually doing the job for them? So there we are, two major currencies there in Europe, strong relationship between them. And then we got the British pound. Now the British pound at one time was an oil-backed currency, but of course that's going back a good many years, and the oil is largely now sort of running out. And of course the UK economy, which moved away from being the manufacturing powerhouse of the world, going back to the Industrial Revolution and beyond, is now completely changed to being a service-based economy. So we've got all sorts of invisibles that largely come from the City of London, etc. And one of the problems, of course, and this is one of the reasons that had a bit of a problem of getting into the euro, was that the country just runs a trade deficit. But of course, it is seen as independent of the woes of Europe at the moment. So now let's go on then to the Japanese yen. Now, this is one of the largest world exporters, very, very, very good at setting up all sorts of manufacturing bases in other countries, etc. And in terms of square miles, a relatively small country, but a very industrious one. However, the internal economy is really not bubbling along, which a good many commentators are putting back to loose money way back about 20 odd years ago. There were massive asset price bubbles, and these were the forerunners of QE. QE, quantitative easing, is something that Japan has indulged in. Still got a major problem. Their tax take is less than the interest that they are having to pay out just on their QE, and they've got quite a few problems with their domestic economy. And it's an oil sensitive currency in that they've got to import every single barrel. Yeah, they've got alternative energies, they've got a little bit of nuclear, hydro, and so on. So there we are. Yeah, absolutely, Roger. That's right. Yeah. Could well. Yeah, guilt by association. Right, over to the Australian economy. Now, I haven't got the New Zealand in here, but the two actually go very, very close together. The larger of the two, of course, is Australia. And one of the real big things about Australia is that they produce gold. They've got a whole stack of gold, which they produce. I'm not quite sure of the numbers, but I think it's something like 6 or so billion per year exports of gold. And the economy has been very, 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 very strong. In fact, so strong that it has shown some signs of bubbling over. I mean, for instance, all of those little indicators of domestic economy when house prices end up getting to be such a high multiple of average earnings that people can no longer afford to buy them. All of that stuff happening in Australia. And they've always had consistently high interest rates, as have the New Zealanders, and consequently yeah, absolutely right, yeah. And consequently, the New Zealand dollar and indeed the Aussie dollar has been a real favourite of the carry trade with the JPY. Right, okay, so, and we can't leave out the CAD, the loonie, which has got a double whammy. It's an oil producer, and as time goes on, technological advances means that oil and gas can now be extracted from oil shale, of which they had loads and loads of these shale and tar sands, which they didn't know what to do with 10 years ago. Now they found ways of actually extracting the mineral, the oil from it, and so it's a very, very strong oil economy. Now the consequence of that and gold is that if oil and gold are going up, then what is likely to happen to the CAD, assuming that everything else remains equal? Absolutely right. It's got to go up. It's got to go up, assuming that there are no other influences upon it. Their major trading partner, because they're immediately next door, and the fact that they've got so much oil, and the US has got an enormous appetite for oil, then what we're going to find is that they are totally dependent. Round about 80% of their exports go into the US, and little comment there, Roger, going back to the UK and Ireland, well, there is a fantastic amount of trade between the UK and Ireland. In all sorts of ways, you know, from basic agriculture to all sorts of services. But yeah, there is that very, very great dependence on the US. So just by getting a handle on these last few slides, these last few aspects, you can start to sort of build up a picture and create an awareness that something is going to, you know, what's going on with a commodity or a particular country is going to affect the exchange rates. Absolutely, yeah. Keep the Guinness going. Right, so let's just consider one or two of these correlations. Right, correlation number one that we're just going to consider for a moment is the Japanese yen versus crude oil. Now, this is the way it works. Japan imports all its oil. So a falling oil price is generally good for the yen, but it's negative for the Canadians. Okay, right? So that's basic tenet number one. So let's just look at the chart. Now you should see in front of you, yeah, I think it's just popped up. What we got at the top is a chart of crude. Okay, it's a standard crude contract. And then directly underneath it, what do we got? We got a chart of the CAD JPY. Okay, CAD JPY. So it's CAD JAPY. And let's just follow this through. From October, over on the left-hand side, what do we got? Well, we've got a rising oil price and a rising currency. It reaches a peak. And then we've got oil, which doesn't just tank, but it meanders on a sloping consolidation, which then accelerates. That's very often what happens, actually, with a sloping consolidation. Quite often get an acceleration, and on down it goes. Now, what's been happening to the currency in the meantime? Well, the currency has been following the same sort of path, albeit, as we can see, with greater fluctuations. So we've got a real zigzag move there, and wave watchers will spot an ABC there, an ABC move. Now, the currency then bottomed, and it's interesting now just to compare these peaks and troughs, because it bottomed, okay, the currency bottomed just, okay, before December, at the end of November. But that was just the time when there was the last gasp, there's the exhaustion in the oil price. On down it went. On down it went. But then it picked up and it moved on up, and at the same time, albeit a little bit of a blip where there was a divergence, then the currency went up. So there we are, entirely consistent with with the general theory. Yeah, good question that, Harley. Used to trade the futures. Well, there was a time when the retail guy, if you wanted to trade currencies, you just couldn't really trade spot. So, you had to trade the futures, and that's how it was. And, there used to be I used to sort of trade I tell you what, when I sort of started out trading, the Mid-America was quite a good exchange because you had quite a neat small contract size, and you could trade that and then move up to the border trade. But the futures was the only way that I could trade currencies to start with. But then the spot market really opened up, and to my mind, the spot market is a purer market. It's where the majority of the big trade flows of currencies take place, and with spot, there's so much more participation. It is getting better on the futures. There's so much more participation. It trades through 24 hours. Gaps and so on, unheard of, more or less, apart from the major news announcements and sometimes on a Sunday night. So there's a whole stack of reasons why spot is the better one to trade. And of course, for those times that we do want to get involved in the carry trade, then that's the way to go. So good question. I don't really know the answer, Harley. But I guess there's a fair old bit of hedging that goes on with that. Good question, that, Alex. Well, got to move on. Can't do the same thing forever. And at the time when I was actually in the education world, I was spending more time trading than I was actually educating after a while. So, I thought it was probably about time to move on, go do something else. So anyway, guys, just looking at this chart now, I hope that you get a couple of people together from the world of education, no matter where that world is. And unfortunately, we tend to be pushed around as more or less surrogate civil servants. Right. So we've got this relationship then, and just by observing where things get out of kilter. Now, we've got this sort of move on down, and as you can see there on oil, just to the left of this vertical line, we've got a little peak. Now, that more or less coincided with this other little peak, but it actually had overdone it. It had overdone it. And then sort of price sort of moved on quite considerably. And we see yet again where the oil price has gone up, and it's been going up consistently. And then there was a little bit of a wobble. Now, there were other things, not just oil, which was actually affecting here. And then up until this time, I do apologize, this is not an absolutely up-to-date chart, but it's there we are in the springtime. What we actually found was that the oil price was still rising, and what was being left behind was actually the currency. So one will lead the other. It is not always a foregone conclusion of exactly which one will lead, but very often you will see little divergences which will actually tell the story. And there was that absolutely classic one way back there in the changeover between November and December, when quite clearly the currency had bottomed. Did the currency know something about what was going to be going on with the oil price? So there is a tremendous opportunity for currency traders to trade oil and for oil traders to trade currency interchangeably. So there we go. Right, that's correlation, most important, number one. Now then, the world currency is the US dollar. I wonder if we'll ever get a genuine world currency where we're all using exactly the same medium of exchange. Wouldn't that be interesting? Can't ever see it actually coming to pass, but there we go. So, the majority of the major commodities, and I lump into that gold, copper, oil, etc., are priced in US dollars. Now, this can cause a little bit of a problem, and it can create some wrong impressions. So, let's just consider this for a moment. Let's say we've got, let's have a lump of copper, or we've got a big lump of copper pipe. Pretty valuable at the moment, you know. Copper's sort of way up there at its highs. So we've got this lump of copper, and we know the intrinsic value in it because this copper pipe, or this lump of copper, can be, you know, extruded into copper pipe that we can sell because plumbers need it, etc., and it's needed for all manner of things. So we know that there is an intrinsic value in this lump of copper that we have. So, and we know the demand, and the demand is sort of pretty static. It's not sort of it's not sort of going up or down. It's got a degree of flexibility in the price based on supply and demand. In fact, it's got quite a lot, as we've currently seen. But let's just assume that the intrinsic value of it remains absolutely static. Now, if, because of something unconnected with copper, the US dollar actually falls in value, what's happened to that lump of copper? Well, it's still got the same intrinsic value. That lump of copper can still only be extruded into exactly the same amount of copper pipe that can be sold to exactly the same number of house builders, but the price of it will have actually gone up in US dollars. So that's one of the problems that there is associated with major commodities being priced in US dollars. Quite often, one can look at a price rise in the likes of copper or one of these other commodities and think, oh, yeah, demand is increasing, demand's increasing. But when you scratch the surface, you find out that's not actually the case. What's happened is that the currency that it's actually priced in has fallen in value. Consequently, to sell that lump of copper, you're going to need more dollars. Leading question there. The answer might come out a little bit later on there, Alex. So, there's always this inverse relationship between the US dollar and any commodity priced in US dollars. And of course, gold is the big one, copper, oil, and so on. And there are a good many of them. So, let's just look at one or two other little correlations here. Excuse me a second, I just need a quick drink of lemonade. Back with you. Right, what we're looking at on this particular chart then is the US dollar and crude oil. So what we've got down below here, we've got the WTI, that's the standard US, the West Texas contract. The other one, of course, is the London Brent crude. Two sort of standard contracts. There are all sorts of anyone who trades commodities, oil, will know that there are all sorts of variations, and there's the derivatives of heating oil, etc., which are very, very important markets in themselves. Have all got a relationship back to both crude oil, but things like heating oil will fluctuate like crazy. In the winter when there's going to be strong demand for heating oil, that will sort of start to take off all by itself, and so on. So there are all sorts of little sort of variation type contracts within the oil world. But the point that we're going to look at here is that the chart at the top now is the euro against the US dollar, and I'm actually using this as a proxy, all right, a proxy for the dollar index, the DXY. Now, the reason I'm doing that is that if I were to put a chart of the DX here, it would be moving inversely, whereas this one is moving more or less with the oil price. Okay? Do you see that? Because the US dollar is, the base is the euro, and the quote pair is the US dollar. And if I had the dollar index up there, it would actually be effectively the other way round. Now, why can I use the euro as a proxy for the dollar index? Well, for a very simple reason. That the dollar index is just a basket. It's just a basket of currencies, just like any other index, which is like a basket of stocks. This is the dollar index is, and the biggest lump in the basket is actually the euro. It's around about, could stand corrected on this, 57% of the constituents of the dollar index. Okay, so any movement in the dollar index is going to be kicked off by movements in the euro. Now, it might be the other way around as well from times when, yeah, we could use that. Absolutely, yeah. There are a whole stack of these that we can use, a whole stack of them. But the one little point that I want to make here is, and I want to get to the reasons why these just might be generally moving together. Now, what we've got to be slightly careful of is that we've got a rising oil price, okay, from the left-hand side of this chart up to the top here. And in general, we've got a relatively flat euro and US dollar, albeit from, if we just take some troughs and peaks, we've got it rising somewhat. But then it moved into a down phase. So what actually happened? Well, look at the times. We get the crude oil price just prior to the 14th, okay? Just prior, and it had peaked. And just look at that candle formation for a moment. We've got a candle there with a long tail. It's got the characteristics of a partially bearish candle. Got the characteristics of a partial shooting star. Following that, there's a little doji, which is also inside the extremities of the preceding candle, so it doesn't quite know where it's going to go next. And the one after that completely engulfs the doji. So the combination of those three candles is very, very bearish indeed. Now, what was going on with the currency at that time, just prior to the 14th? Well, bullish. Still going up. So what we've actually got there, we've got the oil price peaking, moving down before the currency moves. And then, of course, it catches on, shooting star, etc., waits for a little while, and eventually, down it tumbles. And the two follow together. So, why is the question? Why should this be? Well, it's fairly straightforward. If the oil price is coming down, then that's going to be good for the US dollar. It's going to be good for the US economy because they import so much of the stuff. Then it's not going to cost them quite so much. And because of this chart is the euro, we see the euro coming down against a strengthening dollar. Right, okay, so it has to be said that there were some other factors at play, of course, in the oil price at that particular time, most notably Goldman Sachs. But anyway, absolutely right. And the simple fact that it's priced in dollars, absolutely right. So there we go. That's just looking at that US dollar crude oil. And I just must throw this in. Correlations, they're always far from perfect, okay? And the lead often changes. So it's never an absolutely foregone conclusion. It's never a foregone conclusion as to which one is going to be totally the perfect one. Right, sorry, Borgie. Let's just move on there. That, I guess, is the one that you wanted a quick glance at. Now displaying. Right, so there we go. Let's move on. Fine. Pleasure. Right, okay, let's look at another correlation. Now then, let's look at the US dollar in relation to the S&P 500. Now, the S&P 500 is the largest single individual stock market in the world, and then what we generally find is that we are going to get then a relationship between the S&P and the other major world stock markets. Now, that's certainly true of the S&P and the FTSE 100, for instance, in the UK, and also, to an extent, the DAX, the German index, and the CAC, the CAC, the French index, closely follows the DAX. I mean, they are very, very closely correlated indeed. So whatever happens with the S&P, this is the dog that wags the tail, and the tail are those other stock markets of the world. Yeah, thanks, Harley. Good point. Yeah, absolutely. So what will very often happen then is that there is this relationship then between the dollar index and the S&P. And this is how it works. We've got a rising S&P, okay, and we've got a falling dollar index. Now, this one can be completely perverse at times because there are several influences here. One of those influences is this, that where you've got a domestic stock market, let's just forget the S&P for a moment, but let's just consider a smaller stock market. In, say, I don't know, Sweden or Norway, somewhere like that, which is it is its own market. Yes, it will be influenced by some of the other stock markets, but there will be a whole stack of local influences which will crowd out some of the global effects. Now, if that stock market starts to increase, and because that stock market is increasing, it looks very much as if the economy of that smaller country is growing, and it's a real good prospect, then that's likely to attract money in from overseas. Okay. And if money comes into that market from outside of the country, what is that likely to do to the domestic currency? Okay. Well, yeah, it's going to tend to make it rise. Now, that is a general rule, but that general rule is here to be broken. And it gets broken with the S&P. Now, the S&P is an enormous market, and there are all sorts of influences upon it, of which one of the major ones is going to be interest rates. Absolutely right. Yeah, indeed, Martin, spot on. So there is going to be some encouragement for that to rise, but the major influence is going to be interest rates. Now, as the US dollar index starts to move on down. Oh yeah, most definitely, Jack. Yeah. As the US dollar index moves down, okay, then that implies that interest rates are also falling, because falling interest rates make it slightly less attractive to hold US dollars. So the US dollar tends to come down. And it's the prospect of those lowering interest rates which will push the S&P up. And this is how it works. So, and it's how it's working currently. I have to throw that word in, how it's working currently. Now, what we could have done was rather like that previous slide where I could be using the euro. Now, if I'd have used the euro instead of the US dollar index, we would find that this particular chart would be inverted, and it would be following more or less what's actually going on with the S&P. But this is the slightly purer version. Now, where we've got the little green line there on the S&P over on the left-hand side moving up, and we've got the green line on the bottom chart actually moving down, then that's as it should be. But then that relationship starts to break down, and we get the dollar index moving on down somewhat further, and we then find that the relationship has actually broken. But then it actually comes back into kilter. See where that little dotted line is there, more or less in the middle. What have we got? We've got the S&P collapsing, and the dollar index rises very, very, very strongly indeed. Okay, so there we are. As this rises, it's implying that interest rates will have to, will start to rise, and that's not good for the stock market. So we get a little out of kilter blip here, which would produce an opportunity to actually get into this one, and then once again we got the relationship. Okay, and then finally on this chart we've got the dollar index moving all the way on down in 09. Okay, and then in 09 we've got the stock market generally rising. So there we are. That's the next and most important correlation which is holding true. Now, some of these correlations you can link up. There's strong correlation between the Japanese yen, for instance, and the S&P, and this, although it's shown here on each one of these is weekly, and it's obviously going back a number of years, you can actually bring this right down in the time frames, absolutely right down in the time frames. You can even look at it on a 5-minute chart. And there are times when these do absolutely work marvelously. Now, yeah, that's an interesting question there, Roger. Is it the interest rate that drives the dollar, or does the does the exchange rate actually drive the interest rate? Generally speaking, it's the former. Generally speaking, but with that next comment, what explains the disconnection? Then it's entirely possible that there will be other influences that creep in, other things that suddenly hit the market, something unexpected crops up, which just breaks the relationship temporarily. And Alex, you are so right. You are so right. The bond market is the important market of the lot. Right, okay, now, forgot I actually had a 5-minute chart there. I just mentioned it, but yeah, we got a 5-minute chart. This is just a little snapshot in time. So we've got 5 minutes. Each candle is 5 minutes. Got the color charts on there, just picking out the trend, and we've got this move up over there on the left-hand side of the S&P. Well, what's happening with the dollar index? Well, it's moving down, and that's absolutely right. Here we've got the S&P leading the change. It's leading the change. So in general, we've got the S&P moving down then for the next few hours, and then away we go. We've got the US dollar index moving up. Then we've got the dollar index flat to slightly down, and we've then got this one moving on up. So I encourage you guys to put charts of these two alongside each other, and yeah, of which there are quite a number of the real big players, but the bond market in general is the big daddy of them all, which will drive all of the main asset classes. Right, okay, guys. So there we are. We've got a couple of correlations there that you can use, that you can look at. You can put one chart against another. So where you see a divergence, meaning that one goes out of kilter with the other, meaning that one does not follow this relationship, then look for it to come back into line again. Look for it to come back into line. That's what we're always looking for. Divergences that then converge. Yeah, I mean, Paul's got it there. The 10-year is one of the best ones to watch. What I would recommend is that on, as we are, this is all hosted by FX Street. FX Street have got some really excellent resources and links to other resources where you can look at the relative interest rates and bond yields over a variety of different countries, and it will split them up. So you've got 5-year rates, 10-year rates, and I think they go out to 30-year rates. And you can start to look at things like the yield curve. You can start to see which if the short-term rates are converging with the longer-term rates, etc. And I'd strongly recommend that you do that. Just have a little tour around FX Street. Look up what is it? Rates and currencies, I think, or something like that, and you'll find some links to it. Good stuff. Good stuff. Yeah. Well, you know, it depends which country we're talking about and so on. And you know, I think that we are still going to see quite a lot of machinations going on with the yield curve. Right. Okay. So let's look at the next general relationship, and it's with gold. Surprise, surprise. So you get an increase in the gold price, then what we're going to get, all other things being equal and remaining static, is that the Australian dollar is going to rise vis-a-vis the US, okay? Because the Australians are a bigger gold producer than the US. I'm quite sure how much the US produces, but they do produce gold, but in much smaller quantities than the Australian in relation to the size of their economy, okay? So gold production and export from the US, it is there, but in relation to the size of their economy, it's minuscule. Whereas gold production in Australia in relation to the Australian economy is really quite substantial. So there we are. Australian income gets a boost, the economy booms, and consequently a booming economy feeds through into the prospect of having to raise interest rates in order to stop that boom just bubbling over and getting too much. Right, now the other one to benefit by the rising oil price is going to be the New Zealand dollar, because that is also a significant gold producer in relation to the size of its economy. Okay. Now then, rising gold price, the euro versus the USD is likely to increase as the US dollar falls. The CAD, the loonie, is likely to rise as it is also a significant gold producer. The Swissy is also likely to rise as it is a currency partially backed by gold. No, Port, it does have its moments. Absolutely, yeah. Take a good look at that CRB index. Now, I've forgotten exactly what the relative weightings and so on are on the CRB index. Got it tucked away here somewhere. But it's well worth sort of using that, and you know, you can sort of get a pretty good impression from it, because gold is a pretty sort of large constituent of the index. But there are a whole stack of these, and whichever ones you've got access to, play around with them, and you may well find that some are better than others. And of course, the big trick is to try and find some of those divergences, and you know, you may well find that divergence is clearer with some than with others. Right, okay, so there we are. Let's just look at those gold relationships. Let's have a look at one or two others. Now, having mentioned then that bonds are the big one, then let's just consider what is going on with bond yields. Now, as bond yields rise, that means that investors in those bonds are actually going to be paid more money for holding them. Then the actual value of the bonds themselves fall. That's one of these lockstep relationships which does not change. It's like a couple of cogwheels that run together. The correlation is 100% between, more or less, between bond yields and the value of them. Okay, so rising bond yields then, as bonds falls, then the denominated currency of the bonds, okay, tends to rise as hot money flows in to grab the yield. Okay, so that is a real clear and most important relationship which holds true. Next one, we've got a rising oil price. We've got the CAD rising then, going back to those earlier comments, guys. CAD versus the USD is going to increase, etc. The CAD versus the JPY is going to increase for the reasons stated earlier that Japan has to import the stuff. Canada has got these reserves. The US is largely dependent upon imported oil. Now, let's just consider then what's actually happening then with a falling Dow Jones. Then, of course, we're then going to get falling major stock markets. Now, here we are. We're all currency people here, and we're hosted by FX Street. But just consider for a moment, keeping in mind some of the relationships that there are between the various different stock markets. And we're talking about correlations. So there's no reason why you shouldn't keep your chart of the Dow and keep alongside it a chart of the CAC, and keep alongside that a chart of the CAC and the FTSE 100. And when you start to see divergences, you can play the convergence. You can play the game of them coming back to converge. And with those major stock markets, there are major differences between them, but they are all interdependent. So if there is something which in one of those countries is starting to push the main stock market index away from some of the others, then look for the snap back, look for the move back, and there are a whole stack of little plays that you can do. Pairs trading, effectively. Pairs trading. Right, so let's go on to a leading indicator. Right, okay. Major point number one, Forex markets discount into the future, always anticipating the future path of rates. So if rates start to increase, that is interest rates start to increase, whilst the domestic currency is still falling, then look for something to change. Now, sometimes this relationship doesn't really quite work out. Sometimes you can get a country that is moving, okay? It's moving from a previous downtrend. I'll just talk through this while we do that. Okay, where we've got, say, interest rates in a country which have been falling, and they're falling because the economy is not doing all that well, and they're falling in an attempt to encourage more people to take on debt, more companies to take on debt to get the economy going again. Right? So that's the standard thing that happens in economies. But then, for probably a whole variety of reasons, it's decided that those interest rates are too low, possibly because the currency just keeps falling, and interest rates were increased to try and get that currency to stop falling, but the currency keeps falling. Why is that? Well, it's because of the previous momentum. It's because the market previously was saying that, God, blimey, the economy of that country, it's tanking, it's going down. We don't actually think that the economy is actually going to reverse. So what does the central bank manage to do? Well, they increase rates yet again. And at some point, the market will think, well, maybe the economy is not that bad after all. And just look at their interest rates in relation to other countries. It's moving up. So why don't we get stuck in and buy into that country? And then the whole thing can reverse. Eventually, a reversal is highly likely to happen. So whenever you see signaled, you pick up on FX Street, news wires, etc., that central bank is reversing a previous policy of either higher or lower interest rates, look for the currency to return. The interest rate will move first. Absolutely right. Yeah, Martin, that's couldn't have put it better myself. And that's absolutely right. They price in this effect all the time, and of course, what you've always got to be very, very careful of is that other economic conditions and so on. There was the Iceland effect where people were investors, local authorities, funds and so on, pushed a whole load of money into Iceland because their interest rates were sky high, 13, 14% people were getting, and I thought, great, yeah, absolutely fine, without looking at the downside, and of course, hindsight is a wonderful thing, and we know exactly what happened with Iceland. There is a reason why interest rates are going to be considerably higher than interest rates in another country, and that is the risk premium. So you get to a point where interest rates have to be put up ridiculously high, unsustainably high, and the fact that the investors are receiving that higher interest rate is their risk premium, meaning that they could lose the lot. They could just lose. Yeah, absolutely right. Absolutely right. Yeah, good point. So there we go. Now let's just look at some differentials. Now this is the little chart of world interest rates. So let's just have a look at one or two of these. Now, what we've actually got here, we've got the various countries down the left-hand side, and we've got the current interest rate, and it states when it was last changed. So on this little list, let's look at the highest and the lowest. Well, the highest is the one right down here at the bottom. It's 4.75%, and that's Australian rates, and the lowest is this one here at 0.1, and that's Japan. Now we can look at one or two others. The major central banks are the ones at the top. We can then sort of look below, and you find that Egyptian rates are pretty high, and you can sort of look at some of these other ones. India is pretty high and rising, etc. Korea, Taiwan, New Zealand, which okay, it's not a major central bank, but it's certainly very, very stable. And then we can look over here, and you can see the attractiveness of getting involved in Brazil, for instance, where, look at that, the Brazilian economy is absolutely going gangbusters. Consequently, the interest rate is relatively high to attempt to choke off any overheating. So, if we could find within here that we've got one of these which is wanting to reduce rates and the other one is wanting to increase rates, then given that knowledge, we could put a trade on. Now, I will just say that this list has come from FX Street. If you go to the page on which this is, you can just click on any of these, and up pops a very neat little chart which shows very, very clearly what the history was. You can see a chart of the individual currency changes, and you can see when they happened. Very, very useful facility, that one. Yeah, I do from time to time. In fact, I've got a couple on at the moment, which they're a little bit of both, because what very often happens is that you get a double whammy effect, and not only do you get the interest paid to you by going long, as we find here, the high yield currency, but you can also get the capital gain. So this is the process. This is it. Carry trade. Step one then, find a high yield currency from stable economy that has also got growth prospects. Now that is all important. It's all important because as with any trade, you want to get in early. The earlier that you can get in as an economy starts to recover, then you've got the maximum upside. If you get in after the economy has been sort of bubbling and rising for probably years, then the risk goes up that you might be buying in near the top of the economy that could be going down. So it's got to have growth prospects. It's got to have growth prospects. Step 2, you find a low yield currency which is also stable. Now, ideally, you want this other currency to be so stable that it doesn't move. You really want this to do absolutely nothing. It might have a bit of downside in it, even better, but you don't want volatility. You do not want volatility in this second currency. So what do? You buy the high yielder against the low. So let's do this one. Let's look at the Australian dollar, which is currently 4.25% against the Japanese yen at 0.1%. And we would pocket the difference. In fact, on the spot market, we get paid every day, and we get paid the relative amount every day. Right, okay, so what the carry trader can do then is to pocket the difference between the two. Now, what we've got is a 4.65% differential. There will, of course, be a haircut because we've got banks and brokers in the middle, so they're going to want to take some of this. Now, I've mentioned this one at the moment, but there's a big word of caution on this one. I'm not, although I've put the words down there, I'm not suggesting you should get involved in this one right now because, and there's a simple reason for this, and that is that the Australian dollar has been going up a long way for a long time, and the economy is now not, in fact, to my mind, the growth prospects are not like they were 5 years ago. Growth prospects now are looking a little bit diminished. And Alex, I think you are absolutely right there. My own feelings entirely, and this one just might not work out. But this is purely for illustrative purposes. Now, let's look at the next thing. This is an all-important slide. Now, it's a historic one, but it's here for a reason. Now, this is the New Zealand dollar. Now, the New Zealand dollar has had rates considerably higher than where they are right now. In actual fact, rates are currently around about where they are at 3%, but this is going back. But they were higher than this, considerably higher. In fact, they were double what they were on this chart. But the point I want to get down to is that if we just look at the red line for a moment, ignore the blue, just look at the red. Okay, just got the red. And we've got the exchange rate moving on down. Okay, we've got the exchange rate moving down up until 2000. Right, now let's look at the blue. And the blue line are the interest rate differentials, okay, between New Zealand and the US. Meaning that interest rates in New Zealand were lower and going lower than they were in the US. Right, let's roll forward, 2000 then being the base, and what happened to the interest rate differential, the differential between New Zealand rates and US rates? Look at it. They started to rise. They started to rise. In fact, that's one of these standard little multi-point reversals that I trade. And what did it do? It started to rise even though the currency was still falling. Okay, so you've got an early warning signal there. And that early warning signal was saying, get ready for the New Zealand dollar to rise against the US. Well, interest rates had to go a little bit higher than that. It, bit like a super tanker, it took a year to turn this round. All right? But when it did turn round, currency couldn't quite believe what was going on, set up yet another multi-point reversal on it well after the interest rates had turned, and then it took off. And it started to rise, and it rose, and it rose. So the carry trade investor here is not only going to get the difference in yield, all right, which is worth a fair old bit, but that investor is also going to be getting the capital gain in the pips as it moves on up. So there we go. Absolutely right. Yeah. So the blue line here is showing that rates in New Zealand are rising faster than rates in the US. Okay? So it's attractive for people who've got their money in US dollars to take it out of US dollars and switch it round and switch it into New Zealand dollars. So there we go. On up it whizzes, and it just might go on for years. Now then, that's the rule. New Zealand dollar rates started moving above USD rates. Currency then absolutely got moving. Now, yeah, eventually this cannot go on forever. And just look at this chart. In a minute. In a second. Wait for the internet. Yep. So, this is a chart of the New Zealand dollar against Japanese yen. It is monthly. It goes back to the year 2000 that we were just looking at when things turned the corner. It took well over a year. Well, it took just about a year for the reversal to actually happen. But just look at it from 2002 right the way through until well into 2007. Look at that capital gain. Wouldn't you just like to pick up those pips? And along the way, you would be picking up every single day a nice little dividend coming in the form of the carry trade differential interest. So that's what the game was all about. Now then, a real note of caution here, because as price moved on up, yeah, this is where the game is. This is where the long-term money flows are playing. This is the playground of the big funds. And you and I can get involved as well. And just before we close, in fact, I'm going to save this for the next session, I shall just mention where to look right now. But there was a little blip right up here where the arrow is, and prices collapsed down. And shall I tell you what happened? Can't remember his name at the moment, but there was the Japanese finance minister made a comment one day. It was an off-the-cuff comment, and whilst Japanese interest rates were low and getting lower, he just happened to mention, interesting that our interest rates are so low. I wonder if they will keep going lower. Can't remember the exact quote, but it's words to that effect. There was an immediate panic in the carry trade market. There was a big sell-off because if the other side of the trade, that stable currency, if that interest rate started to increase, then the carry trade suddenly becomes less attractive. And there was a mad rush for the exits, and this move down was dramatic. Just look at the numbers. 84 all the way down to 70. Big pips. Okay. Well, it all sort of recovered, and then other little comments then came out of Japan saying, no, we're quite comfortable with low interest rates. In fact, probably we want to try and get interest rates even lower. Everyone piled back into the carry trade, and it then ran for the best part of another year. But I don't need to tell you what happened in late 2000. And just look at that. Bit of a problem. As we got the global credit crunch, then money had to be pulled out. Absolutely had to be pulled out. And it was pulled out big time. The carry trade works brilliantly when you are long the high yielding currency which keeps going up. But unfortunately, if it goes the other way, you've got a problem. If during this time you'd actually bought the Japanese yen against the New Zealand dollar, you would be paying the interest rate all the time. So always make sure you're on the on the right side. If your currency trade is one where you've got a substantial interest rate differential, you really just want to be on the long side. You don't want to be on the short, because if you're on the short side, you are paying the interest to somebody else. Right, okay, well there you go. Now, interest rate differential charts, again, have a good tour around FX Street. You can pick various ones up there. You can actually pick up all of these from, haven't got the links I'm afraid, but you can pick them up from the central bank's sites. To some extent, you've got to keep your own charts of the actual differential charts, those that I was showing you just a little bit earlier on. You can get them on, if you've got Bloomberg, you can get them on Bloomberg. And indeed, you can just make your own up. You can just keep the data on a spreadsheet, just what the different charts are. Really, really good. So, guys, we're now virtually, well, not virtually, we are at the end of the session. And what I just wanted to mention to you, which I'm going to mention in the premium section a little bit later on, take a close look at short the Japanese yen, long some of the other currencies, of which there are quite a number. And you can look at things like the AJ, that's the Aussie against Japanese yen, you can look at the euro against the Japanese yen, etc. And at the moment, then, it is looking as if, and this has been on the go for about a month now, that it looks very much as if we've got a little bit of carry trade working through on there. Anyway, guys, all that remains is for me to say thank you for listening, and hope to see you again sometime soon. All the best for now. Take care.